Well, joining me to talk about the latest inflation numbers, some good news for the president and the White House, is Mark Hamrick from Bankrate. He's joining us to help give us the inside scoop on what's going on with these numbers, which can sometimes be a little bit confusing. Sometimes there's a little devil in the details rather than just looking at the big numbers. So, Mark, thanks for coming back on the DC Debrief. How are you?
Great to be with you, John. Thanks for having me.
Absolutely. It's always a pleasure. And so, we got good news, right? I mean, these numbers are trending in the right direction. You go from 4% year over year last month to 3% this last month. I know there's some underlying numbers that are better than others. Can you just kind of give us a quick snapshot of what it is that we saw with this latest data?
Sure. I think this is one of those things where, the statistics, the stats can be complicated, but consumers have a pretty, I would say, generally solid awareness of what's going on with the prices because it's something that they interact with on a regular basis and have obviously been frustrated by really going back for a couple of years now. We think last summer when the year over year increase in the consumer price index peaked at 9.1%, and that was the highest inflation we'd seen in 40 years. Thankfully, as you say, that year over year change in the latest read on this measure of prices at the retail level, up just 3%. And actually, that was rounded up. The true number is something like 2.97%, just in the sense of, I was thinking, well, this number will probably have a three handle, and that's the way it is reported. But truthfully, it's 2.97. Statistically insignificant, but nevertheless interesting, at least to me. So we're in a better place. Has been both better and better than expected news on inflation, both the retail read and the follow-up read of producer prices, the wholesale price index, and the year-over-year change on the PPI, quite remarkable. It's up just 0.1%. And you would tend to look at that as perhaps even being the better news in the sense of we're thinking about prices as they are farther away, not yet reaching the consumer, and that is trending even better. So the Federal Reserve has a 2% inflation target. We're not there yet, but we're in a better place. And I think you mentioned at the outset as well that some of the things that are perhaps most relevant in looking at all these things. The price of food remains elevated. The price or cost of shelter, we need a place to live, remains elevated. New car prices are still higher. Car insurance is higher. Used car prices are coming down. And energy, except for electricity, is down. So a lot of these things are moving in a much more favorable pattern, I would say.
Given the numbers that we're seeing now, there's always been worry that we're heading towards a recession, that the Fed may have to keep raising rates to a point where it would trigger a recession. But now we're starting to hear more belief, maybe, that we could be getting a soft landing here, that maybe we can get back to a solid economy, solid economic growth without having to incur a recession, without having to have that unemployment rate jump up. Do you see that as a more realistic possibility now than maybe you did a month ago or 2 months ago?
Well, a recession does not seem to be imminent. We will always have a recession. That's part of the economic cycle. The question is when and the depth and duration or severity of it. And to your point, yes, I mean every single data point that suggests that growth is continuing, that the economy is relatively stable, is sort of like to keep the landing analogy going. It's like, as they say among pilots, any landing you could walk away from is a good one. Well, so far we haven't had a landing per se for the economy because growth has persisted at roughly a 2% annual rate of late, from best we can tell. And so that's a good thing. But I would note we do a lot of work on surveys at Bankrate, both of the general public, essentially consumers, everyday people, as well as quote unquote experts. And we just published a series of stories that was written by my colleague, Sarah Foster, based on our quarterly economist survey. And among the things that the economists say collectively is that the risk of recession over the next year remains elevated. They're putting those odds at roughly 1 in 2. And that's lower, actually, than it had been in the last, I think, 3 surveys. I'm thinking the first quarter of 2022, they had put that risk at 1 in 3, and then it had gone above 50-50 for, I think, the following 3 quarters. So that's still pretty high, but I also like to say, that old glass half full, half empty analogy. When the glass is half full, it's actually half empty as well.
Yeah.
And the reason I say that is because 50-50 means that it's not a certainty that we have a recession in
Right.
next year. So obviously something to continue to watch.
And one of the other things that we're watching is what the Fed does next. It seems clear that inflation is heading in the right direction. I mean, we're a big drop from 9% a year ago to now 3%. It seems like we're pretty close to 2%, and even though we're not there yet. So it sounds like the Fed is going to raise interest rates the next time around. Do you agree with that assessment? And if so, could that be the last time? I mean, obviously, we don't know what other data is lurking in the weeds to perhaps jump up and surprise everyone. But if we continue in this trajectory here, do we need a whole lot more interest rate increases by the Fed in order to get inflation back down to 2%?
You're absolutely right, John. The expectation is that at the end of July meeting, the Fed will raise rates by the slightest amount, 1/4 of 1% or 25 basis points. And that's within the context of 500 basis points of monetary policy tightening that has occurred since March of last year. And so the bulk of that medicine has been administered. And although it's sort of nerdy or technical, central bankers talk about monetary policy, or their primary tool in monetary policy being an adjustment of interest rates, as working with long and variable lags. Well, what does that really mean? Well, what it means is that certain parts of the economy feel the impacts of these rate hikes more quickly than others. And again, we began this in March of last year. And let's think about the fact that as inflation was raging out of control, and that's why the Fed sort of hopped on that rate raising bandwagon finally. A number of different things occurred, including a bear market in stocks, the crash of cryptocurrency, which has sort of recovered a good deal since, and a huge slowdown on the housing market. And by the way, this week at Bankrate, our average for the 30-year fixed rate, sort of the workhorse of home purchase financing, is back at a level that was last seen in November at 7.07%. So that's going to have further insult to injury with respect to housing affordability. But all these trends that are worth watching. And to wrap it up on the Fed piece, I do think because the following meeting for them will be in September, they'll have a lot of data to digest. And I think that because of those variable lags with monetary policy and the thought that a lot of this has yet to totally work its way through the system, the other part is that the Fed believes that the banking sector was slowing lending, which is absolutely something we're seeing. And part of this is related to what happened with the bank failures in March. That will essentially do some of the Fed's heavy lifting for it with respect to slowing the economy. So the rate hikes that have already taken place, at least one more yet to come, and slowing lending, as well as the fact that the consumer is sort of, in a sense, running out of some gas to the
Mhm.
extent that they've depleted some of the so-called excess savings they accumulated during the pandemic. I think all those things will mean that the Fed thinks that its job is pretty close to being done, or may well be done with respect to further rate hikes.
Right, because one of the things I've seen from some folks is the cure worse than the disease, right? I mean, if you're at 3% and you're moving in the right direction, can you live with 3% inflation for a period of 6 months to a year, and without raising the interest rate, and just keep the unemployment where it is, keep the rest of the economy moving where it is? Because one of the other things we saw was that wage growth outpaced the rate of inflation by 1.2% in this last month. And if that continues, if those numbers continue to trend in the right direction, is it still necessary to continue raising rates, or would the cure to get back down to 2%, would that be worse than the disease, the resulting recession be worse than the unemployment that would result from it, if we're already moving in a good direction?
Yeah, good observations, good question there. And ultimately, we don't know, right? And I mean, meaning that a monetary policy is a blunt instrument. It's not surgical, and some of this is really more art than science.
Yeah.
So it could well be the case as we get on down the would-be road that the Fed would have raised rates too much, but uh, sort of across the board, Federal Reserve officials are saying that inflation remains too high. And there are other measures of inflation, of course, as well, not just the ones that we're talking about. But what Chairman Powell says and would say is that when inflation is high, the economy is not working well for anyone, or I might paraphrase it and say everyone.
Mm.
And I think that's right. And but you make a very good observation there as well that so-called real wages, or wages adjusted for inflation, are now in positive territory, and that may well continue to be the case if inflation remains low and lower, and wages remain at least somewhat elevated, or at least in positive territory. That's a dynamic that wage earners and consumers have not experienced much of over the past 2.5 years.
Last question for you on this. Obviously, in the last year, we've seen inflation slow tremendously, 9% a year ago to 3%. The target is to get to 2%. It would seem, based on that level of drop from 12 months ago to now, that it shouldn't be much of a problem to get from 3% to 2%. But can you just describe maybe some of the difficulty in traversing that last 1% to get to where they want to be?
Yeah, and from a sort of discussion among economist types standpoint, it's pretty simple, and that is that services inflation, which now is sort of what's doing most of the um, aggravation of inflation, so to speak, tends to be the word is stickier, meaning that it's harder to sort of bring down. And that may well continue to be the case. And the other part is, and we didn't even get into this yet, but we need to think about the fact as well that there are going to be many, many dollars still flowing into the U.S. economy, having to do with the Inflation Reduction Act, the CHIPS Act, a lot of spending on infrastructure, and spending that has already been agreed to. And that is sort of going to provide some foundation to jobs creation really over the next decade or so. So
Mm.
not necessarily a huge contributor to inflation, but just something to think about as sort of providing a foundation. But I'm optimistic. I think there is a good chance that we could get out of this relatively unscathed, because the inflation itself was pretty bad. And we also have experienced some pretty severe recessions in this country in the last couple of go rounds. We had a peak of unemployment of 14.7% early in the pandemic, and 10% after the great financial crisis. No one is predicting a recession of that type or those types next time around, and we'll pray that that's the case.
Yeah. Well, this is continuing to move forward, and make sure you're reading everything Mark Hamrick and all of his colleagues over at Bankrate are doing by going to bankrate.com. Mark, thank you so much for joining me on the DC Debrief to help straighten this all out for us. Really appreciate it.
My pleasure, John. Thanks for having me.